Welcome to Share Views with my co-host Stefania Balbaglia from Cassiopeia Services, and with our special guest Chris Bailey, who's making his second appearance on Share Views. I'm not quite sure why you came back, Chris, but you're from Financial Orbit.
That's right, Zach, and very nice to be here again. Happy New Year.
Happy New Year to you. Remind us what Financial Orbit do, because it sounds like something from outer space.
Well, we attempt not to be from outer space, something sort of a bit more real world, but essentially two things. Number one is we consult with people who want advice and insights on global macro or individual stocks. And we're also in the process of launching a fund as well in order to distill some of the views that I've generated over 20 odd years of investment management and related activities. So exciting times for Financial Orbit, but exciting times for the world as well.
Isn't it a degree of pressure having money on the line in the current environment, let's say?
It is, but I think it's a truly opportunistic time because you've got some mega macro events out there, Brexit, Mr. Trump, what the Chinese are getting up to, etc. And you align that with a lack of dispersion in stock markets at the stock level. So I think 2017 is all about exciting stock level driven opportunities. So if you're an active investor, it's going to be an interesting year. Macro-volutility, stock level opportunity, put the two together, interesting backdrop.
And you think even if interest rates double or triple in the next year, the stock market will still be okay?
The answer is probably not if that was the case, but they're not going to do that, Zach. The reality is interest rates are going to go up a touch in the States, but very little. A bit of inflation is coming back, but central banks will play fast and loose with policy. So what you'll see is a little bit of inflation, a little bit more growth. That's opportunistic for the world stock markets. But what it means is that the best companies will come once again to the fore. None of this, or less of this sort of non-discriminatory look at the world, everything goes up or everything goes down. There's going to be much greater differentiation, great for active stock pickers, sell your index funds, get active again.
But which sectors are we talking about? It's obviously not the retail sector at the moment, is it?
Well, actually, I think retail is quite interesting in the UK, but we can get onto that in a sec. At the sector level, you've got to be sector anarchic, no doubt about that. There's opportunities all over the areas. But the reality is you're going to see greater differentiation. So in every single sector you can name, financials, retail, minerals, etc., you'll see good and bad companies, as it should always be. So what I'm looking for are companies with market-leading positions, good balance sheets, and management that know what they're doing. Because it isn't, an effortless, easy backdrop out there. There are challenges, there are things to work through. You mentioned retail, great example. So far in the sort of the few days since Christmas, with the trading statements coming out, we've seen a real shabby trading statement from Next, but great opportunities here at 40 odd pounds a share, a clear buy in the FTSE 100. Because they've got a good management team. It's not a fast fashion friendly stock. It's middle of the road, got a good balance sheet. They sort of know what they're doing. They'll recover. You'll make money on Next shares in 2017.
Shares have halved from their best levels.
Yeah, but that's because they were massively overvalued back at £80, £70, £80 a year ago. Today at £40, much more opportunistic. Did I own them back then? No. Do I own them today? Absolutely, because it's good value. And that's what I mean. It's sector anarchic. You look at retail and you think retail is unattractive because we've got no real wage increases in the UK. We've got high debt levels. We've got the whole Brexit uncertainty. But the reality is much of that is factored in at prevailing share prices. What you need are companies with good balance sheets, loyalish customers, some kind of market position that can be sustained. That's Next. So Next at £40, clear buy for me at prevailing levels. That would be a good example of how things like Brexit and uncertainty generally can lead to good opportunities. And there's plenty of those.
So, Chris, why we are seeing such an uncertainty in the currency and money system? We saw also the Bitcoin, it reached its highest record this week. Now, Bitcoin is compared to gold as a safe haven asset. If you have to choose between the two, which one would you buy?
Yeah, gold every time. And we're speaking at a time when Bitcoin has been tremendously volatile. As we speak, it's down very heavily today. You go back a few days, it was up very strongly. The difference between gold and Bitcoin is very clear to me. Gold, I like the fact you can physically touch gold. And that's been its store of value, its medium of exchange, its rationale for being an alternative currency for thousands of years. Bitcoin, I understand what it is, cryptocurrencies and related, it's all very clever, all very 21st century. But the reality is I'm still not convinced by the technology, convinced that I can have full confidence that I'm going to be able to use it, I'm going to get repaid, I'm not going to lose a large amount of money. over some period of time. So very clear, gold versus Bitcoin, gold every single time.
But how safe is gold? I mean, I remember. Well, I seem to remember that in the 1930s, the U.S. government banned the people having gold, and I think they're doing the same kind of draconian thing in China at the moment.
They certainly confiscated.
And apparently, they also sometimes they fiddle the price a bit as well.
Well, gold price manipulation, we can talk for that for hours, of course. But the reality is, Zach, if you get to this point where the governments of the world start confiscating or prohibiting gold ownership, you know, a bit like Groucho Marx said, that the only club to be worthwhile a member of is one that doesn't want you to be a member of. You should buy gold. Gold is an ultimate safe haven in that sort of eventuality. It's persisted for thousands of years. That's why all portfolios, no matter where you are on the risk spectrum, should have circa 10% of their assets invested in gold or gold-facing opportunities.
Well, isn't it better to go for Rand Gold Resources or something which is a better safe? I mean, they're unlikely to ban that.
Absolutely, and Rand Gold is my favourite large cap gold stock at the moment. One which I've had in my investments for many years now, and for me is still a core 2016 buy and hold here. So Rand Gold is a very good example of a great gold company. They know what they're doing, experienced. They build mines with double-digit returns at $1,000 per ounce gold. So you've got a margin of safety there. Absolutely. What I do is I have the majority of my investments in gold in names like Rand Gold, and then a little bit in physical ETFs for a bit of balance. I would agree with that. Gold, it makes a lot of sense in 2017.
Right. I mean, we're at the start of the year, and normally when anybody makes a prediction at the start of the year, after like 2 weeks, they get a pie in the face. So I'm going to ask you to come up with some of your outlook and some of your resolutions for the year. Well, what's on you? What do you think the best way of making money this year will be?
Okay, so from a macro backdrop, for UK investors, two very interesting themes are going to happen. Number one is the pound is going to go up against the US dollar. And that changes the sort of investments you want in, I look predominantly at large and mid-cap securities. It changes the type of FTSE 100 company you want to buy. So the pound goes up. I'm going for 135 plus against the dollar by the end of the year. And if that happens, mining companies will be okay. Gold will do absolutely fine. But where you want to be focusing on are some of the more domestic-centred stocks. We've touched on Next already. They're interesting. I also think areas such as companies such as Whitbread, for example, look very attractive at prevailing levels. So it changes the sort of investments you want. Maybe take some profits in the industrial miners, focus on gold instead in that space. Look at other areas other than pharmaceuticals or sort of exporting industrials. Focus on some of the more domestic plays. So the Next and Whitbreads and EasyJets of this world, still all stocks that I like. So that'd be from a UK perspective.
I mean, EasyJet and Next are hated at the moment.
Which is why you should love
Marks
them.
and Spencer is going to be hated. Probably Burberry will be hated.
Because absolutely, but these are all stocks I love. So, my view is always you want to be greedy when others are fearful. If people are fearful on these stocks, you want to be greedy.
And love things that other people hate.
Precisely.
And hate things that other people love.
Precisely. You know all the phrases. You've been here before. Yes. You've seen these.
Same with relationships as well.
I'm not sure about that. You're probably better qualified than me to talk about that type of thing. I know nothing about that sort of stuff. Look, the other big theme is the emerging markets. Emerging markets are going to be okay. China's going to be okay. The dollar's going to fade a little bit, and that means any companies with embedded emerging market exposures are going to be kind of interesting too. So they're my two themes for 2017. Pound's going to go up, emerging markets are going to be okay. That means where you're looking to invest has to change. It's no longer about buying people that are benefiting from dollar exposure. Actually, take profits there or move out of those areas completely. Focus on beneficiaries of a pound that recovers, actually a Eurozone that's going to be okay, and emerging markets that are going to be absolutely fine.
The Eurozone's going to be okay?
It's going to be okay. Don't worry. Marine Le Pen's not going to be elected president of France. Mrs M in Germany is going to be re-elected. Europe's going to be okay. The Euro's going to go up. That means anything with European exposure, DS Smith, Croda in the FTSE 100, FTSE 250, they are clear buys as well.
Well, I was going to say you owe me a pint if all your predictions come to pass, because there is no way that you're going to have Merkel. You're going to have, this one of these things is going to happen.
We'll run all up in sort of some mass accumulator, Zach. It's going to be absolutely okay.
Are you still going to have Italy in the Eurozone?
Italy's not going to leave the Eurozone. They've got too much debt.
Yeah.
They cannot leave the Eurozone. And five-star, whatever the populist party is going to be called,
they are not able to deal with.
I agree. There is no way they are going to be in power in any shape or form. So Italy will be absolutely fine as well. Although I wouldn't invest in Italian banks. I think they're a bit
You're
beyond
going
the
to be
pale.
owing me about like a whole barrel of pints by the end of the year, probably the end of the first quarter actually.
Well, there you go, Zach. It's going to be a good Christmas for you then.
And the other thing is, just to finish off, the pound getting stronger. You've got the interest rate outlooks on the US and the UK. Here, Carney would rather die than raise rates, and in the US, you've got the Fed likely to raise rates probably more than will just be able to sort of placate Trump,
Yes.
probably
Yes.
as much as anything else. How's the pound going to go up?
So
Plus a hard Brexit as well, Article 50 at the end of March.
all these things are known knowns. So everyone thinks that the US are going to raise rates. 3 times, I think, seems to be the consensus call. This is exactly what we had like this time last year. Last year it was 4 times. It ended up being 1 in December. Same thing's going to happen this year. You're not going to see many interest rate rises. That means that the dollar's going to fade because it's all factored in. Mr. Trump, actually, I think he wants a lower dollar. Lower dollar means more jobs. You can't have the Mexican peso and the Chinese yuan and all the other currencies getting ever cheaper against the dollar. He wants more jobs. He will push the dollar down a little bit. US rates won't go up as much. And then everything else will kind of fall out from that. If the dollar goes down, the pound goes up. Simple as that.
Well, I have to say, there are very few people in the world I disagree with more than you on almost every matter known to
Nothing
humanity.
changes then, Zach, from
Nothing
last time.
changes. That makes it all the more fun. But thank you very much, Chris Bailey
Pleasure.
from Financial Orbit, for joining us today on Share Views.